You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today, I have the pleasure of having Mark Gomes. Mark has compounded at an incredible rate of return, 40% over roughly the last 20 years. So it's absolutely incredible to have someone with Mark's acclaim on the podcast. You know, we're going to be here talking about all things investing, process, research, etc. So Mark, thank you so much for being on the podcast. It's awesome to have you here.
Yeah, thanks for having me.
Mark, so I want to start with your background, talk a bit about how you got into the business and sort of how number one, your investment process as a whole has evolved since you got started to where you are today.
Sure. So I went to Northeastern University in Boston on a athletic scholarship, got out of there with a business degree and into a tough job market. Took several months to get a job. The job that I got was unimpressive. $10, $11 a year job, $10, $11 per hour job. And I did have some friends that were a little more fortunate to get into better organizations. And one of them got me into a company by the name of International Data Corporation, IDC. IDC provides market research on the technology space, specifically information technology. My job was simply to take forecasts, market share reports, things like that, specific pages out of those reports, photocopy them, and fax them to whatever Wall Street client wanted them. All right, so low-level job for a college kid, but it got my foot in the door. I got to meet some heavyweights. People had some big names on Wall Street. Started to be able to use a little bit of my financial background and eventually made my way up to being an assistant analyst, a real analyst, et cetera, and got to the point where eventually I was in charge of the buy-side program at IDC, which was basically taking all the information at IDC and saying, what does this mean for stocks? So rather than having the customer come to us for information and figure it out, we were going to them with our information saying, hey, look, you should probably look at this company because of this is what's going on in the technology industry right now. And this happened just before the beginning of the internet boom. So what was really, again, fortunate for myself is that at the time that I built this new business within IDC, there was another company that was emerging as an internet consultancy called AMR Research. They did enterprise software, so ERP, CRM, Salesforce.com, Oracle, SAP, those types of names. They were more in depth. They would help GM, GE, companies like that make decisions on what software would make their organizations more efficient. So as you can imagine, when the internet came in, all these companies, it was called, they were afraid of getting Amazoned. That actually became a word. They didn't want to get Amazoned like Barnes & Noble and Borders Bookstore did. So they were coming to us for our advice on, are these internet technologies real? And if so, what do we need to do about it? Okay, fast forward to the end of 1999, big internet bubble, almost anything related to the internet was going crazy.
Yep.
But there was a problem from our end. From our end, the number of requests for information just suddenly dropped off a cliff in November. The request for proposals dropped off a cliff in December. And we knew, based on the fact that we actually helped companies negotiate deals, that would mean that deal closings were going to drop off a cliff in Q1 of 2000. So obviously, me being in charge of the Wall Street program at AMR, called all the customers starting in November and say, this is it. You have to get out, because by the time we get into the heavy quarterly earnings reports for either Q4 or Q1, the guidance is not going to look good. And sure enough, if you look back on the charts, you'll see March 9th, 2000, the NASDAQ peaked and spent the next 2 years straight down. Okay. So long story, but it gets somewhere. We get through that. 2004, I'm negotiating with Gartner Group, Forrester Research, all the major technology research firms to start a new practice within those organizations, bigger organizations. Ultimately, I decided, why should I start a new research organization for anybody else when I could just become a customer of all of them and have all the information and be the one that has the best information for Wall Street? That way, with that message, I could go to Wall Street and say, don't worry about getting IDC or AMR or Gartner or Forrester. I got them all. And I will go through them all and tell you exactly what to do with it, so you don't have to go through it. I'll save you $250,000 a year and all that time for $50,000 a year, let's say. And that built up into a nice business. 4 years later, I was retired, got on Seeking Alpha because I was bored. You can't do nothing for the rest of your life. I thought you could sit on a beach at Cancun for the rest of life. You can't do that, right? Started blogging on Seeking Alpha. Next thing you know, I've got a big following because the picks, here's where the punchline comes. When you have access to industry experts who really know which products are best, it's a cheat code, because you know that those experts are going to be advising customers to buy those products. I knew Workday, WDAY, before it was even named as a company. And we knew from the strategy that they came in and told our executives that they were going to be the next PeopleSoft. And if you don't remember PeopleSoft way back, that became a giant. That was a company that went up 100% a year for many years until Oracle bought them out. So we knew Workday was going to be a major hit before it was even a public company. Things like that, right? So I've continued in that process of focusing on having the most in-depth information, knowing my goal is to know more about the companies I invest in than, in some cases, the executives themselves. I want to be an asset to the execs. I want to be able to tell the executives something they don't know. And that makes me an asset. It gives me better access. And of course, when you have great access and great information, you make great picks.
Yep. And, I think sort of the best part about your background is you also is number one, the fact that you've got access to all these industry, like these experts. But, on the other hand, how do you actually go about, building a research process sort of around this, way of thinking? How do you, so what all do you look for in companies before you actually go ahead and pick them? So number one, you mentioned product, which is obviously vital, but so what else do you look at? And, how do you go thinking about that?
Yeah, sure. So, and that's a shorter story. It really comes down to this. There are trends in the marketplace. Okay. So there are, at any given point in time, there is any number of technologies that are proliferating in the marketplace. And those technologies are going to have an impact on certain things that happen in life and in other areas of technology. And many of them also necessitate certain things. So for us to get to the point where Netflix could be a big thing as it exists today, we needed to have enough internet bandwidth.
Yeah.
And before there was enough internet bandwidth to stream Netflix, what did you get? DVDs from Netflix, right? So by looking ahead to what's happening, right? Good example, electric vehicles. Tesla on the cutting edge of how much mileage you can get out of a full battery, right? the reason that they're on that cutting edge, well, the reason is because they like to be on the cutting edge, but the reason that they are actually leading in that regard is because they're using something called silicon carbide instead of silicon. So if you know anything about silicon carbide, the experts you talk to the experts in the semiconductor industry, what's going on? Why does Tesla cars travel further than other electric vehicles? They say, oh, because they're using silicon carbide. Well, okay, what's that all about? Well, it's a replacement for silicon. It's better, but it's newer, so there are problems with it. And I said, well, how do they solve the problems? And eventually you come to the realization, if you know a lot of technology companies, that they needed a testing solution to test all these chips. So what ends up happening? Air Test Systems, AEHR, goes from $2.50 to almost $25 in a 3-month span, because all of a sudden they're getting tons of orders for machines to test Tesla's chips. See? So it becomes very easy to connect those dots in terms of trends. Now, the question from there becomes, let's say you find AEHR not at $2.50, but at $10. Yep. Do you buy it at 10, even though it's gone up from 250? Well, I'm a little late to the game. Well, that's where the math comes in, right? I speak to the companies, build operating models based around how big is the industry, how much of the industry do I expect them to capture? That's revenue, right? From the revenue, I can go to the CEO or the CFO and say, so for each additional 10 million of revenue, what will your cost of goods sold be on that additional revenue? You might have an infrastructure to where you have to sell 10 million worth of a product before you even have any gross margin at all because of the overhead. But after that, maybe your gross margins are 90%.
Yep.
You have to understand that stuff. So if you know how to build an operating model, I won't get into how to build an operating model. A lot of your folks should probably know, or if you don't know, look it up. We can predict pretty easily how much EPS a company is going to generate if we have an idea of how much revenue they're going to generate in a year, 2 years, et cetera. And then you can just say, wow, this stock could be $30 in 2 years. I'm very much willing to pay $10 today for that.
Yep.
But it starts with that industry expertise of knowing, yes, silicon carbide's big. Yes, these chips are hard to make. Yes, they need to be tested. And yes, this is basically the only company that does that. Well, now it's a no-brainer, right? You just test the valuation to figure out where it needs to go, but you got a no-brainer on your hands. You got a company that is going to grow. And all you have to answer is the question, is it going to grow enough to justify a valuation or justify me getting the kind of 40% annual returns that I look for?
Yep. And so, as you mentioned, your primary way of generating ideas is to look at primary trends, then speak to people who know a lot about them. Do you have any other ways of generating investment ideas? Do you ever depend on, say, stock screens or trying to figure out, they're trying to filter stuff by, say, a low PE or high gross margin, etc.
Yeah. It used to be more investor conferences. Okay, so for example, the LD Micro Conference, I go to every single one of those if I am available. Yeah. I go to every one that I'm available to go to. At that conference, my partners and I can meet a total of probably 50 different companies. Mm-hmm. And by meeting those companies, we can assess what's going on in the companies and then go back to our industry resources to validate what we've heard. So it reverses the process a little bit from that top layer, right? So that's a good source of leads. If we find 50 companies, we might boil that down to, let's say, less than 10 that we really want to dig into and call our contacts and find out, is this really real? And out of those, maybe there's 5 that we really go deep into. And out of those, maybe there's 3 we end up buying, and maybe 1 or 2 we end up shorting as well. Okay, so that's one part of the process. The other part of the process is that over time, I've built a large following, right? And inevitably a certain number of those people in that following want to follow in your footsteps, not just follow your picks, but follow your process. And so now it's gotten to the point where it's less necessary for us to do the topmost layer, because a lot of these good prospects are coming to us directly from those people within our network.
Yeah, I see. And also, one other sort of big part of process is this idea of pattern, or like recognizing patterns with number one, between different opportunities, but also, just just in general, sort of recognizing, okay, so so for example, you talked about AEHR. There's probably some stock in the past that sort of resembled the way AEHR sort of resembled the opportunity that AEHR presented. So could you talk a little bit about pattern recognition and how that fits into your process as well?
Right. So what I'll preach at the top level is that every situation is different. Everything's a snowflake. I don't like patterns. I don't like to think about things in patterns. However, I will think about things in terms of experience. So in the case of AHR, we can use that as a great example, because back in 2005, there was a company called Intevac, still a public company, IVAC. And what was similar about them, they're not the same at all, but what's similar about them, both of them sell capital equipment into a large industry. IVAC was selling machines that helped to create hard drives, to help process the platters that go into the hard drives. Okay. Around that time frame, 2004, 2005, we got to the point where hard drives needed new technology to allow more megabytes, gigabytes to fit on a single hard drive. In order to do that, they had to go from having all the data flat on the surface to making the data three-dimensional on the surface, so that you could put multiple layers of data on a single disk. You needed all new equipment to accomplish that. Well, who was making the equipment? Only two companies, and Intevac was the biggest. So their revenue in 2 subsequent years went from 65 to 130 to 250 million in revenue, as the industry soaked in all of that capital equipment they needed to upgrade themselves to this next perpendicular media recording paradigm in the hard drive business. So that's where you could say, okay, this is very similar, because silicon carbide is taking the industry by storm, right? Anybody that wants that extra 20% boost on an electric vehicle is going to want to use silicon carbide. And if they want to use silicon carbide, there's a good chance they're going to need to test those chips with an air machine. So for at least the next couple of years, you're going to see these machines being purchased by the semiconductor manufacturers. In fact, they've got a backlog that lasts several quarters into the future based on the build out plans of their customers, right? Now the question becomes from there, again, valuation, because in the case of Intevac, even as their revenues was still rising, the stock peaked because of the sentiment that peaked out. People saw, my God, the revenues doubled, and the forecast called from the double again next year, and the sentiment got wild. And of course, when sentiment gets to an extreme, that's a contrary indicator. Good sentiment, positively moving sentiment is great, but once it peaks, it's a problem. And that will happen with retail investors from a sentiment standpoint, but sentiment for institutional investors comes from valuation, right? So once Intevac got, let's say, $30 a share, the institutions were saying, wow, we made great money from 10 to 30, but we don't really see, using discounted cash flow analyses and all this, this is not going to last forever. This company should maybe be worth 15 or 20, not 30, based on just what's going to happen next year, because after next year, we're going to see those revenues start to fall off, because the industry will have built out all the infrastructure they need for years to come. And sure enough, the stock's actually right back to where it was when we found it. It went from 5 to 35, and now it's right back to 5. So these are things you have to look out for. But that was a 20-month process. We're only in month 3 of Air, but Air has moved a lot faster than Intevac has. So that's where the math is really important.
Yep. And when you talk about number one, sentiment and how it peaked, so obviously when sentiment is sort of at its peak, that's sort of when the risk reward is sort of at its worst. And risk reward is something that's very, I guess, integral to your process. So could you talk a little bit about your methodology for evaluating risk versus reward? And also, do tools like technical analysis sort of fit into that framework, or is it just purely based on, I guess, fundamental or quote unquote some amount of statistics, say like the Kelly criterion, etc. So how do you think about risk versus reward, and could you sort of explain that with an example? Because I think it would sort of go over a lot better with an example than without.
Sure. So quite simply, what I'm looking to do is figure out, what do I think this company is going to be worth, let's say 2 years from now? Okay. Let's take SMSI, $5 stock. I think the stock can be 25 next year, 40 the year after that. Okay. Based on math, based on my analysis, based on the in-depth analysis of the company, the industry, how big the industry could be, how much money they should make, the success that they had with Sprint before, and therefore the success I expect that they should have with T-Mobile, Verizon, and AT&T. Right. Okay. So when I run all that math, it tells me this company could be 25 next year and 40 the year after, and they could continue to grow at a certain rate. So what I can do is plot those points on a chart. I can put $25 on a chart 1 year from now. I can put $40 on a chart 2 years from now. I use free stock charts for this, so I can go into the future on the chart.
Yep.
Draw the line out and make the slope of the line, right? When you're looking at a technical chart, you've got basically, two parallel lines is the most common technical chart. So if you have these two parallel lines, right? This one right here represents what I think they can do. Here's today, here's $25 in the future, here's $40 a couple of years in the future. Draw the line. Does that line have a decent slope relative to how fast I think the company can grow? Because if you've got a company that makes $1 EPS and gets a 30 PE, the stock's 30, right?
Yep.
A lot of times that stock will get that 30 PE because the expectation is that it's going to grow 30% per year. Well, if it grows 30%, the next year they make $1.30 of EPS. And if they're still growing at 30% per year, then the stock will be at 39 on that same 30 PE. What happened? The slope of the stock's trajectory mirrored its growth. That makes sense, right? Where the bottom line comes in is there's a risk involved. Maybe this doesn't all play out. Maybe it takes a little bit longer. Maybe they lose one of the accounts. There's a lot of maybes that can stop what's feasible to happen. And you calculate all that as well, right? Taking into account how volatile the stock has been in the past. Some stocks move like this and some move like this,
Yep.
right? And you have to take that into account, right? And when you do, then you could take that first line that's very fundamentally oriented, where it's going to go in the future, and put a parallel line underneath it. And you say, you know what? For me, anytime the stock is down here, anywhere in this ballpark, I'm going to want to buy it. Anytime it's up here, I'm going to want to take some profits off the table, maybe sell some calls or whatever, or reassess the situation and say, you know what? Everybody's excited about this, but to me, it seems like the story is playing out. It's time for me to move on to something else. Because let's face it, if we're constantly finding stocks that are down near this line right here, why hold on to stocks up here?
Yeah.
Right. So you can take that long-term approach, but if you're all the way up at the highest potential point, then you don't have much reward left. Right. If everything plays out the way you want and the stock's right here, you got this much to go to get rewarded for the company doing what you thought it could do. If it's at 38 and I thought it could go to 40 and nothing's changed, I've only got $2 of upside left. But what if one day you wake up and they lose AT&T? That thing's going to probably drop from 38 to 28. So you just risked $10 of downside risk for $2 of reward. And that's how I describe risk reward. Now, technicals, what'll often happen is that because there are a lot of people that value company on the basis of fundamentals, there is a floor right? There's a certain point where for me, it was, $5 on Smith Micro, where I was like, anytime I free up capital, I'm going to buy more Smith. I'm going to buy more Smith. I'm going to buy more Smith. What's that? That's support. And in technical analysis, that's represented by a line, right? There's support here. Yes, that's me, a fundamentalist, pouring hundreds of thousands of dollars into this stock, right? So it shouldn't come as a surprise that oftentimes, not always, but oftentimes, a technical chart, the two parallel lines that I showed, will not be just based on fundamentals, but based on the technicals. Somebody who knows nothing about the company might say, hey, look, the stock's gone like this. If I draw a line over all the tops and under all the bottoms, here is my two parallel lines, and I'm going to buy low and sell high. You can do that, but it works a lot better when you have confidence in the company's fundamental valuation.
Yeah, I think that was a sort of a great explanation on just thinking about risk reward. And when you think about so let's say you've just found Smith Micro. So how do you think about your allocation strategy from that framework? So does it start off with, say, a 3% starter position, or do you see, okay, so this stock could actually be a home run, I'm going to actually start off with, say, a 5 to 7% position and sort of build it all the way up to 15 to 20%? How do you think about allocating stocks? Does it start off small and then grow big, and does it all, and then does it also, as you mentioned, it clearly depends a lot on technicals and sort of thinking about channels and patterns on the chart as well. So how do you think about allocating? How do you think about allocating within this risk reward framework?
Sure. So there's a little bit of art, a little bit of science, right? So we can use air as an example. The idea of air comes to my attention. Now, I had known air for 7 years before all this silicon carbide thing came and really took the company by storm. And we didn't even know anything about silicon carbide 7 years ago. It was the other drivers that we expected to help the company. So, we got our eye on the company. I know the CEO. I've known him for many years. I meet him every time I can out in LA at the LD conference, and we just catch up. And I want to stay on top of this guy, because if one of these days they get a groundswell of orders, the stock could really move. Cool. And one day, little bird whispers in your ear, the silicon carbide thing. Well, what do I know about silicon carbide? It sounds like it makes sense, but if you listen to every CEO story, you would buy every stock, just about, right? Like many stocks sound great that end up being complete busts. Many of them are just pumps, right? So how do you know the difference? Well, you got to spend time talking to the industry experts, validating the information, checking the competition, blah, 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 blah. And as you do that, let's say it takes me 4 weeks to do all that. Whatever I do in week 1 might lead me to say, I think there's a good chance that when I'm done with this analysis 3 weeks from now, I'm going to decide that this is a big winner that I want to go full position on, right? And for me, at my level of net worth, my full position is 10%, let's say. Okay. For somebody newer, you can have 15% or 20%, depends on your risk tolerance, right? You want to spread your money out, of course, so that you don't completely blow yourself up. But as you get bigger, as you make more and more, you get multi-millions and stuff, you don't want to put too much of your net worth in one stock. So for me, 10%, right? So week 1, it's looking really good. And I think that in the coming weeks, the research that I do is going to lead me to want to own 10% of this company, right? I might buy 2.5% right there. The next week, the research continues to look good. Another 2.5%. Boom, boom. And see, eventually, when we get to the final stage, and if I find, wow, the stock's really cheap, everything I worried about has been checked out, the competition looks favorable for them, the market opportunity looks favorable for them, the valuation looks favorable, people don't really know about this company yet, this is going to blow up, let me put on that full 10% position, draw a risk reward chart based on the process I told you about, and then I'm off to the races. On to the next one, right? I didn't have to look at air again. I was following the news, but all the news was doing was validating everything I expected to see.
Yep.
By that point, you've done so much research into the industry and everything else that you are not really surprised by what you see from the earnings reports, from the analysts. Because what does an analyst do? Like they I forget which firm it was, came out with their initiation report. And what did they say in the initiation report? The same thing I told my readers. It just takes them a little bit longer though, because they got to go through a compliance process. They'll actually talk to their customers for their own customers, their buy side firm customers first before releasing the report broadly to the public, right? So there's a big lag. I'm a lot more flexible. I don't have to wake up to tomorrow, speak to 5 institutions this morning, and listen to 5 earnings calls for the companies that I cover, and then still find a little bit of time to do a little bit of research on this company that I might initiate coverage on weeks into the future. I can drop everything and be weeks ahead of them. So when they do come out with a report, I'm not surprised that they come out with the same findings as I do, because I used to service them, right? I was the independent consultant to Wall Street, giving them the information that went into their report. So I'm not surprised. Sometimes they're going to find things that I didn't, and sometimes I find things that they didn't. But for the most part, the bulk of the report, not surprising. In that case, also with the operating model, I said when this company gets to 100 million, I think that's going to equate to $1 per share of EPS. Sure enough, when the analyst report came out, their forecast for 100 million in revenue showed $1 of EPS. Being ahead of that, if you knew what companies were going to be initiated by Wall Street and what price targets they were going to put out, it would make investing a lot easier, right?
Yep.
And that's kind of what we have. I just don't know that a company is going to initiate coverage on a company that I own stock in, but I know if they do, what that report's probably going to say and what the price target's probably going to be. And I'm invested already, so that's just icing on the cake.
Yeah. And there's so far we've sort of talked about AEHR and SMSI. So what other ideas are you looking at least at this moment in time? So we're speaking 21st October 2021. So what's going on? So what are the various ideas that you're looking at that that seem pretty convincing from an investment standpoint?
Yeah, so the major themes that I'm looking at, and the number one theme that I care about right now, is what companies out there were on the cusp of taking off right before COVID. Because if they were on the cusp of taking off right before COVID, then they're just now getting to the point, now that the Delta variant is subsiding in society, right, that they can finally hit that inflection point. Okay, so in the case of AEHR, right, one of the things that was holding them back, and if you talk to Gain, we couldn't get out to the customers. How are we supposed to sell these machines if we can't have meetings, if we can't get the machines out to customers, if we can't have people in the plants, we can't order these machines? All these things were stopped.
Yep.
Right? Silicon carbide's been in Tesla cars for a little while now, not like years and years and years, but it's relatively new, but it's been out there. And the process to test those semiconductors has been, let's call it, onerous, because they haven't really had access to these Air machines. Well, now that COVID lifts, right, Air wants to do business and the customers want to do business. Hey, we hear that you have a machine that will make our process of testing these semiconductors a lot faster, cheaper, using less space. Let me hear about that, right? So this could have happened already a year and a half ago, but COVID stopped it. So You have that pent up demand, the big pent up demand in a bunch of companies out there, right, that were already ready to blow. Their inflection point was ready. They were at their inflection point and COVID just delayed it, right? And so now the inflection point for a lot of these companies is going to be much stronger, because all the companies that might have done business with them over the last year and a half, that's all just going to come flooding in now. And that's where you see an Air, they've averaged 20 million a year of revenue for the last 5 years. They did the equivalent of 50 million of orders in 3 months, 2.5 years in a little over 2.5 months. Okay, that's a big pent up demand blowing up, and the stock will blow up, right? along with it, of course. You just have to be careful that that pent-up demand, right? Whatever great year they have now, because there's so much pent-up demand, the following year can be a tougher comp. And that's the only thing you have to be careful about. But by that time, we're not worrying about it because, of course, we've got our risk reward lines to guide the way and say, you know what, time to move on, or time to cut down on our risk with a lower allocation. So in that regard, using that theme, right, what are some companies that I have found that were on the cusp of an inflection point before COVID-19 and are now seeing that inflection point hitting? There's 3 companies that come to mind. There's Tech Precision, TPCS. Okay, this is a company that it's not glamorous, right? If you think about it one way, they make precision parts for submarines, helicopters primarily. Okay, and when I say precision, these are parts that almost nobody else can make. They've got very specialized machines. They've got ion beam machines that very precisely. Imagine you're in a submarine. Yep. Do you want that submarine to be sealed with something that let me take a saw and make that escape and make that hatch for you? It's going to take water. It has to be perfect. It has to be precise. Okay. Helicopters, same thing. A very precision machine where everything has to be precise. And right now, right, and actually this was a couple of years ago, the tensions between the US and China and Russia were already bubbling to the surface, and now it's even worse. Well, back before COVID-19 hit, the US government, both Republicans and Democrats, said, hey, we've fallen behind the Russians and the Chinese in terms of our military might. In particular, the Navy, the Chinese Navy is now on par with the US. We can't have that. So this is one of the rare cases where both sides of the aisle, the Democrats and the Republicans, say, we've got an old submarine force and we've got an undermanned submarine force. We need more submarines and we need them to be updated. We need the future, not the past, the old stuff that we have. So now you can see with General Dynamics, and this, you can see this in the news, it's out there, multi-$100 million orders for submarines. CH-53 helicopters coming out, right? New, larger, transport vehicles, transport helicopters to handle the new, larger transport vehicles that take place. So, now we send Marines overseas, we're going to send them in larger land transport vehicles. But what's going to take those land transport vehicles to wherever they need to get to? A chopper. But it needs to be a bigger chopper because these are bigger land transport. So there's this whole upgrade cycle. So similar to IVAC, similar to AEHR, there's this upgrade cycle happening. What has to happen in the military force of the United States, and whether we like it or not, I don't like that it seems to be a new Cold War, and you can Google that. The majority of people in Europe already believe that there is a new Cold War occurring between the US and China, Russia. Yeah. Right. And the last time, not surprising, the last time the military budget was as big as it's going to be next year was the end of the last Cold War, which was in the 80s. So it's been since the 1980s. A lot of investors weren't even alive the last time helicopters and submarines and defense as a sector was hot. But if you look at the defense sector now, never mind TPCS, I mean, it's heating up, but the defense sector has already been hot. Over the last 6-9 months, it's been an outperforming sector because everybody says, wow, this is going to be recession proof. This is where the government's spending their money. We have a GDP gap to fill. The government wants to spend more and more and more money. They want to print more and more and more dollars. Where's all that money going to go? A lot of it's going to go into defense. So let's buy the General Dynamics, right, on the large end. Well, that's not me. I don't want a stock that's going to go from 100 to 130. That's nice. But I'd rather have a stock that's going to go from 1 to 6, something like that. Right. So find the small companies, wait for the General Dynamics to send those orders downstream, which we're now seeing happen. If you read the last transcript or listen to the last call, for the company, for Tech Precision, not just the earnings call, but the acquisition call of Stadco that they makes the helicopters. They actually mentioned how many of these things that they plan to make. So that's them. Now, I'll give you the quick story on the other two. IRIX is Iridex. INFU is Infuse Systems, both involved in medical related fields. And of course, during COVID, right, elective surgeries, all sorts of things related to medical got delayed. We came to a halt. If you need some kind of eye surgery, it's not critical. We're going to put you off, right? Things like that. So those are two other companies that you can check out where they are, in my estimation, at risk reward lows. That's what I love. I've been buying more IRIX and more INFU because they hit that risk reward low that I look for at a perfect time where we see companies like AEHR getting to high heights. The money that I take off the table can go into the new ones sitting at the lower areas. And then I just get to enjoy the tailwind of, now that hospitals are open to elective surgeries, this is where a company like Iridex, IRIX, can benefit. And there are other factors that go into that. They made a big partnership that turned the business that they're in from a major competitive industry to almost like an oligopoly. And that's a major sea change, right? When you go from a highly competitive environment to an oligopolistic environment, that's always positive for a stock.
Yeah.
So very simple themes, right? You just have to dig in below the covers, get to know management, run all the numbers to make sure that you're not jumping into something that's already overvalued.
Exactly. And moving on, I wanted to talk, I guess, more on the psychological aspect of investing. So, what's just generally speaking, what's been sort of your worst mistake as an investor? I guess since you started.
Yeah, I mean, the worst mistake I can remember, in recent history, was a company called Intermap. Okay, and the mistake that I made there was, Intermap supposedly had a multi-$100-million contract in hand with a government in Africa to map the topology of the country, because it's very resource rich. Okay, there's a Congo. Now, what do I know about that? Nothing. I'm not an expert on mapping. I'm not an expert on African business. I don't have contacts that are experts on mapping or the politics of closing a deal in Africa, right? So what I relied upon in that case was, wow, a $300 million deal. This company has a tiny market cap. This is a no-brainer, right? Well, it was only a no-brainer if the deal went through, and it didn't. And I got crushed. I lost hundreds of thousands of dollars on that stock, and I lost some reputation too, because that was, one of my top picks at the time. And so a lot of people that follow my work lost money on that too, and it felt really bad. All right. And it just reinforced to me that having a very methodical process and following that process religiously gives you the confidence to move forward without worrying, without hoping. I don't need to hope SMSI is going to do great. I'm confident that they're going to do great. I didn't need hope that AEHR was going to do great. I had confidence that they were going to do great. And so all of a sudden, emotion comes out of it. Hope is an emotion. Fear is an emotion. When I go to bed at night, I can honestly tell you, I cannot remember the last time I was afraid that one of my stocks were going to blow up the next morning, because of the process I go through. I don't just buy any company. I miss a lot of companies. Yep. I miss a lot of stocks. I miss a lot of winners, but I still double my money every 2 years for the last 26 years. And I still live in a penthouse in Miami Beach. So could I do better? Yeah, but maybe I'd be taking bigger risks in the process. And who needs that when I already have more than I ever need? right? When you're making 7 figures a year, I mean, if you really need to make 8 figures a year, if I need that in my life, there's probably something more wrong in my life than my research methodology, right? So it works.
Yeah. Yeah.
So
And
basically, the answer to your question is, how do I deal with psychology? I try to eliminate it.
yeah.
I try to make this a Mr. Spock type of business, because that's what makes it best.
And there's the fact that so you mentioned that you've well, at least from like a track record or like a return standpoint, you've obviously done really well. So does that ever interfere with you're thinking, okay, like adding sort of like not getting caught up with your historical performance, but also sort of avoiding self-induced pressure to perform, which could lead to below optimal decisions, below optimal decisions when it comes to investing. So you've got this great track record, and now you're sort of forced to replicate that track record going forward. Do you ever see that? Do you ever feel that kind of pressure, or is that non-existent?
Well, there's two answers to that question. There's the internal one and the external one, right? Internally, no. I've gotten to the point now, right, where I will never need anything for the rest of my life as long as I don't make a big mistake.
Yep.
Okay. I have a great woman. I've got a great home. I've got plenty of capital, investments, stocks, things like that will hold a great deal of value. So my life is set. So if I only make 5% a year for the rest of my life, is it going to be distressing? Yeah, because then what would happen? How did all of a sudden the process that was making me 40% a year, all of a sudden not? But I don't worry about that because it's not necessary anymore. If I make 5% a year for the rest of my life, I'm great. But externally, for the people who rely on me that are trying to make money themselves, I don't feel a pressure to perform 40% a year, because if you look at my track record, it's not 40%, 40%, 40%, 40%. There was a year where I had made 300%. There were 2 years out of the last 26. Since 1996, I had 2 down years. One was minus 11%, and one was minus 3%. Okay, they happen, and there was a time where I said, man, I lost 3% this year. I have to make 70% this year to make up for it, to stay on my 40% track. And it's actually more than that, right? But let's not get into exact numbers. But obviously, you have to do better than 40% to make up for a year where you didn't make 40% at all, right? I don't worry about that anymore because I have no control over that. I can just do the best job I can to find the most great picks that I can and let the rest take care of itself. I can't control bear markets. I can't control when everybody else is going to realize what I realize when I do research on a company. I can't control any of that. I can only control buying at an attractive price and selling at an unattractive price, no matter how long it takes for that to get there, right? So that's kind of how I focus on that. And, not for nothing, but it's worked for so long that now we have this big network, and it's not that now it hasn't been a problem of doing 40% a year. We've done over 100% a year for the last 4 years. So our performance actually as a group has only accelerated because there are more and more people embracing this strategy. So imagine if you have 10 people doing the same thing I'm doing. Well, we're going to find 10 picks for every one that I used to find. So now we can cherry pick even further and not just buy each of those 10 great picks, but say which 5 or which 3 of those are really, really the best, like beyond anything that I ever wanted to invest in before. And that's what we're getting now. The Smiths, the AHRs, all these companies just, and having a bull market doesn't hurt either, of course.
Yep. And before this, we just covered sort of your worst decision ever. So on the flip side, what's been your best decision ever from an investing standpoint?
Same answer in reverse, right? Just getting fully religious about focusing on that methodology, dealing with experts, getting to the point where you understand a company as if you work there, right? That's my advantage over everybody else in microcap land. right? Because if you go to the institutional side, if you look at Apple, right? Where am I going to find the advantage on Apple? What could I possibly know about Apple that gives me the gall to say, I know this stock should go up from here more than what it's supposed to, when there are literally hundreds of MBAs, seasoned Wall Street veterans out there in three-piece suits with nothing more to do all day because they're getting their check relies on them covering Apple. Do I want to compete against 100 MBAs in New York City, or do I want to compete against a community of retail investors that don't necessarily have all the tools that Wall Street does, right? So by sticking to my knitting, microcap investing is lower competition than the macro caps. Technology, which is my strength, where I have my contacts, and focusing on those contacts, then I can give myself the best chance of being the smartest person on a particular stock. And if you're the smartest person on a stock, you almost can't lose, right? If you know more about a company and more about the stock than anybody else, you almost can't lose. So it helps the hit rate. And of course I do lose, of course I lose. But the hit rate's great. And when I lose, it's not much. And when I win, it's tremendous, because I'm not looking for a 40% gainer. I'm looking for a 200% gainer, and being satisfied if I'm wrong and only make 100%.
As sort of an investor, what do you consider sort of the best skills to have? Both, I guess, generally say like persistence, as well as say specifically like qualifications.
Yeah. So a few things. Being able to understand the industry that you're digging into is really critical. You have to be humble. So even though I come across as extremely confident, that's different than being cocky. I never let myself think I don't need to call my semiconductor experts because what I'm reading about air looks great. I don't need to call my telecom experts because what I'm reading about Smith Micro looks great. So it's really important to stay humble. The person who says, I know everything, will learn nothing. Why would you ever why would you want to learn anything or try to learn anything if you already know everything? There's no need. I already know everything. I don't need to learn anything. Conversely, the person who says, I know nothing, will learn everything.
Yep.
So every day I say to myself, I know nothing. I know nothing compared to, let's say, Warren Buffett, right? If I'm going to get to his level, if I'm going to be the richest man on the planet from where I am right now, I need to keep learning, right? So it's things like that come into play to keep you on your toes and say, I really want to know as much as possible about this. Now, beyond that, fundamental skills, building an operating model, right? A forward-looking operating model. How much money will a company earn in EPS if sales grow 50% next year? If you learn how to answer that question, beautiful. How to value a company, right? DCF analysis. And then of course, people like EV to sales, PE ratios, things like that. A lot of that's BS, but a lot of investors go by it. So it does factor in, right? So knowing how to value a company, knowing the operating structure, and also very important, what a lot of people miss, particularly in the retail ranks, capital structure. Because there's a lot of companies out there that will, let's say, do a raise, but let's say it includes a ton of warrants, right? And the average investor will look at the market cap and say, oh, the market cap is only X. They only have this many shares outstanding. And they don't look to notice that they have a convert out there, warrants outstanding, options outstanding. And you look at this thing and all of a sudden that's called the capital structure, and the capital structure is a mess, right? Not only that, but maybe their cash is low and they have and they're burning a lot of cash per quarter. Now what are they going to do? Who in their right mind is going to invest in a company with a terrible capital structure that's quickly running out of cash? Nobody. That's a company whose stock can just go from 5 to 1 in a blink, right? And you don't want to be in that stock. You might want to short that stock if you're into shorting, right? So that's another way to make money, but primarily it's a way to protect yourself from not losing money. And that's the one thing that people forget. It's not about buying into the stock that can be a 10 bagger. It's about avoiding the stock that can lose you 90% of your money. I allocate on the basis of risk, not potential reward. I look for high rewards, but I require relatively low risk. So getting all those things together, I think, that makes for a good, well-rounded investor.
Yep. And as Buffett says, rule number one, never lose money. And rule number two, don't forget number one. So clearly that's sort of a vital part of being an investor. And do you ever use options as a fundamental based investor? So at least when you're explaining sort of your risk reward methodology, you talked about selling covered calls at the top, as well as I'm guessing the opposite of that would be selling cash secured puts at the bottom. So do you actually do that, or do you complement your long positions with call options? Do you use, or do you see how do you see or use options as a fundamental investor?
Yeah, that question was beautifully worded, because if you say, do you play options? And half of me says yes, half of me says no. I don't like to buy calls or puts. The reason is they have an expiration date. I first found Air 7 years ago. I invested in them 4 years ago. And if you bought the stock when I first thought it was good and waited all this time, you've made more than 40% a year on that stock. Mm-hmm. But if you bought options, if you bought call options on Air every single month until June of this year, you lost money basically every single month. Putting a time limit on an investment is foolish, because you never know, even if you have the catalyst down. I remember SMSI had what I would consider to be their inflection point quarter with Sprint. There was a quarter that was like, this is it. This stock should take off now. And the next day, the stock was actually down. And then they had another inflection point quarter, and the stock didn't go anywhere. It wasn't until the third quarter where I'm like, nobody's gonna care. Nobody's gonna care. No matter what they say, nobody's gonna care. And they put up another great quarter. And for some reason, that was the quarter where everybody cared, and the stock went up 70% in one day. I had the biggest day of my life that day, right? But I had to wait 6 months for it to happen, because the day of that first quarter that I thought it should take off, it didn't. 3 months later, they had another quarter like that. And then 3 months later, so 6 months passed before the stock really took off. And it went from 2 to 7 in a blink, right? If I had options all those 6 months, I would have gotten killed, right? So I don't play options on the long side for that reason. Now, do I sell covered calls? Yes, right? When a stock is at the risk reward high, I always check the options, because if there's very high premium on the options, I might have the opportunity to really essentially sell above the risk reward line, right? Trim my position by selling calls instead of selling the stock, right? If that makes sense, that is never an emotional decision for me. It's always mathematical. Which one makes more sense? What's a better way to reduce my exposure to this stock? Selling calls or selling the stock? And conversely, when we get to the bottom line, right, when Smith got down to these low levels, if there were people willing to pay a high premium on puts, say, this Smith is bogus, this is a pump, this stock is going to 2. I'm willing to pay big money for the November 5 puts. Well, guess what? I'll be the one selling to you, because I know that what you're thinking is wrong, because I've done the in-depth research. I will pit my research against yours. You're just saying it's a pump because it sounds like a pump. I know it's not a pump. Not every story that sounds like a pump is a pump. In fact, some of the best, look at Amazon. A lot of people thought Amazon was a pump 15, 20 years ago, until they took over the world. And then everybody's like, oh, I guess it's a real company. I guess it's real. I guess they're not just a internet book company. Nope, they're not an internet book company. They're an everything company. And they just took over the world, and you missed it, right? So it's just a matter of what makes sense. So sometimes, yeah, selling puts or selling calls, I like to do that if the math makes sense.
Yep. Awesome. And, to sort of end the podcast, I wanted to ask you, before I let you go, could you sort of tell our listeners where they can find more about you and your work and anywhere you share, ideas, blogs, etc.
Sure. The easiest way, Mark Gomes, MarkGomes, should be on your screen here. markgomesstocks.wordpress.com. You can Google my name, it should come up, right? If you go to my WordPress site, markgomesstocks.wordpress.com, the first article that's pinned to the top will introduce you to how I do things. That's very important. That's your instruction manual. I'm your machine, and that first blog post on that page is the instruction manual to how to use me to your advantage. I was lucky. I had a couple guys took me under their wing, mentored me, allowed me to have the life I have today. And that's what drives me now, right? I've got these free days. So to me, it's nothing to sacrifice an hour of the day to come talk to somebody like yourself, or to go onto my own blog or my own podcast, go on YouTube and share the ideas that I've had for myself with everybody else to kind of share the wealth that's been given to me. So, if it's something that people are interested in, great. If not, there's many ways to make money, and I hope everybody finds theirs.
Awesome. Mark, with that, thank you so much for being on the podcast. I think it was an extremely insightful and awesome interview. So thank you.
Hey, thanks a lot for the time and the great questions. Appreciate it. Great stuff.